The future of money has always been imagined as a destination, but history insists it is better understood as a negotiation that never ends. When I look backward to see forward, I do not search for a final form of money, gold, paper, digital, or code, but for recurring patterns in how societies redefine trust under pressure. Money is not an object. It is an agreement about value, authority, and time, and every era that believed it had perfected that agreement eventually discovered the limits of its own assumptions. The future of money, therefore, is not about invention alone, but about memory, about which lessons are carried forward and which are forgotten at the worst possible moment. In the ancient world, money emerged as a tool of coordination before it became a store of wealth. Grain receipts, silver weights, and coinage existed to simplify obligation in complex societies. What history teaches immediately is that money gained acceptance, not because it was clever, but because it was enforced. Temples, palaces, and later states guaranteed value through power and punishment. Whenever that power weakened through debasement, overexpansion, or political decay, money fragmented. Local substitutes emerged, barter returned, trust retreated inward. The first lesson for the future is stark: money survives innovation only when authority remains credible. Metallic money seemed to solve this problem by anchoring value in physical scarcity. For centuries, gold and silver imposed discipline on rulers and comfort on users. Yet history shows that even hard money was never immune to politics. Coins were clipped, standards were altered, empires inflated quietly when desperate. The illusion that money could be separated from human behavior proved just that, an illusion. The future of money cannot escape politics. It can only choose how visibly politics enters the system. Paper money intensified this tension. It expanded capacity, enabling states to fund wars, infrastructure, and growth far beyond metallic limits. At the same time, it demanded unprecedented trust. Hyperinflations, defaults, and collapses followed whenever discipline failed. What the past reveals is not that paper money is dangerous, but that flexibility without restraint invites catastrophe. The societies that endured were those that built institutions, central banks, fiscal rules, legal independence that constrained themselves even when temptation was strongest. The future of money will depend less on technology than on whether such self-restraint remains politically possible. The 20th century added another layer: managed money. Fiat currencies, central banking, and macroeconomic policy turned money into an instrument of stabilization rather than mere exchange. For a time, this worked remarkably well. Crises were contained, growth expanded, yet success bred complacency. Debt accumulated, asset bubbles formed. The line between emergency measures and normal policy blurred. History warns us that money systems fail not only through chaos, but through gradual erosion of boundaries. The future of money will test whether societies can distinguish flexibility from indulgence. Digital money and financial technology appear today as radical departures, but history sees familiar impulses beneath them. Speed, convenience, inclusion, and control have motivated every monetary shift before. Cryptocurrencies echo ancient desires to escape debasement and authority. Central bank digital currencies echo imperial ambitions to monitor tax and stabilize more efficiently. Private payment systems echo medieval banking networks that thrived where states were weak or slow. None of this is unprecedented. What is new is scale and velocity. Decisions once unfolding over decades now propagate globally in seconds. Memory has less time to intervene. The past also teaches us that monetary systems do not fail at the margins. They fail at the center. Trust collapses not because a new technology appears, but because the old system no longer feels fair, stable, or legitimate. Inequality, perceived favoritism, and moral hazard undermine belief long before balance sheets do. Money loses value when people stop believing it represents a shared future. No algorithm can fix that. The future of money will be decided as much in social contracts as in code bases. Perhaps the most important lesson history offers is that there is no permanent monetary solution. Every system solves the problems of its time and creates the problems of the next. Gold limited rulers, but constrained growth. Fiat enabled growth, but invited excess. Financial innovation distributed risk, but obscured it. Digital money promises efficiency, but risks surveillance and fragmentation. The future will not escape this cycle. It will continue it under new names. And it is here, standing at the intersection of ancient trust and modern technology, that the real question of the future of money comes into focus. Because the issue is not what money will look like, but whether societies will remember that money only works when people believe the rules are legitimate, the burdens are shared, and the system is restrained, even when it could exploit its own power. And as history has shown again and again, the moment those conditions are quietly abandoned is the moment when the future of money stops being a promise and starts becoming a warning that echoes from every collapse that came before and carries us into, will be judged by how that belief is maintained when it is most tempting to abandon it. History's final lesson about the future of money is not technological, but ethical and institutional. Every monetary order survives its early years on innovation and enthusiasm, but it survives its later years only on restraint. The decisive moments come not during invention, but during stress, wars, recessions, inequality, and political temptation, when authorities discover how easily money can be used to delay pain rather than resolve it. In those moments, the future of money is decided quietly, long before crisis makes the verdict visible. Looking ahead, digital money will almost certainly become more prominent, not because it is superior in essence, but because it suits the tempo of modern economies. Instant settlement, programmable payments, and integrated identity systems answer real needs. Yet history insists that convenience is never neutral. Faster money accelerates feedback loops. Errors compound quickly. Surveillance becomes easier than accountability. The question is not whether digital money will work, but who will control its rules, how reversible those rules are, and whether exit remains possible when trust frays. Monetary systems that trap users rather than persuade them do not endure. They fracture. Central bank digital currencies illustrate this tension clearly. They promise efficiency, inclusion, and policy precision. They also concentrate power in unprecedented ways. History offers a warning. Here, monetary authority without visible limits invites abuse, even when intentions are sound. The most stable money regimes were those where power was constrained by institutions, transparency, and credible alternatives. A future of money with no exit options, no competition, no privacy, no recourse would repeat the oldest mistake in a new language, mistaking control for trust, private monies, and decentralized systems. Meanwhile, draw strength from a different historical impulse, the refusal to entrust value entirely to the state. This impulse has surfaced repeatedly whenever official money failed. From medieval banking networks to dollarization to cryptocurrencies, people have always sought parallel stores of value when legitimacy wavered. History suggests these alternatives will persist, not as replacements for state money, but as pressure valves. They flourish when confidence in official systems weakens and recede when stability returns. Their existence is not a threat, it is a signal. The deeper challenge for the future of money lies in distribution. Monetary systems break, not when they are inefficient, but when they are perceived as unfair. Persistent asset inflation alongside stagnant wages, repeated bailouts without accountability, and rules that protect insiders erode belief faster than any technical flaw. History shows that money cannot carry legitimacy if it consistently transfers risk downward and reward upward. No amount of innovation can compensate for that imbalance. The future of money will be decided by whether societies confront this distributional question honestly. Across millennia, one pattern remains unbroken. Money that endures is boring, constrained, and trusted. Money that collapses is flexible, expedient, and abused. Every generation rediscovers this truth after believing it had escaped it. The future will be no different. What changes is not the lesson, but the cost of forgetting it. In a world of instant finance and global contagion, monetary mistakes propagate faster and farther than ever before. The future of money, then, is not a single outcome waiting to arrive. It is a continuous test of memory. Will societies remember that discipline is a feature, not a flaw? Will they accept limits before they are imposed by crisis? Will they design systems that can fail safely, rather than pretend failure is impossible? History does not predict which form money will take next. It predicts something more important, that money will continue to reflect who we trust, what we fear, and how honestly we confront the trade-offs we would rather postpone. If this journey through the past and future of money has sharpened how you think about currencies, institutions, and trust, I invite you to subscribe and continue exploring these financial histories with me, and to leave a comment sharing which historical lesson you believe policymakers are most at risk of forgetting today. Because history shows that money's future is never written by technology alone, but by the willingness of societies to remember why money ever worked in the first place and to act accordingly before the warning signs turn into the next collapse.